Hey everyone, welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to take a step back and talk about expiration. So when we're talking about regular equity expirations, we all know that the last day to trade them is on Friday, but that's not entirely true for different underlyings that we trade. And additionally, we have regular expirations, we've got weeklies, we've got quarterlies, so we're going to dive into each of these and discuss why we would trade these, why we would not, and we'll get right into it. So let's go to the next slide and we'll talk about some expirations. And really what an expiration is the way I like to think of it is when an option expires and converts to either long stock, short stock, or cash. So when we're looking at different expiration types, we've got regular expirations, we've got weekly expirations, we've got quarterly expirations, and we have leaps. So if you're looking at the Doe platform, you might see these letters next to different expirations. So if you're on the trade page and you single click on the singles button, either a call or put, you'll see the expirations pop up on the left and right side. So if you see something with an R next to it, or a W, or a Q, now you know what this means. So if you see a W, you see the weekly expiration, and those are normally a gray or black image, and if you see a regular, you'll generally see that in a blue colored image there. And then if you see a leap, you're not going to really see anything signified by that, but when we're talking about leap options, they're basically longer term options, usually over a year out. So there's multiple different expiration types, and the biggest takeaway from here is that there's going to be different liquidity with these different expirations. So when we're looking at a difference between regular and weekly, for example, a regular expiration is going to be most likely the most liquid. So they're generally the traditional expirations that people trade. While there are weeklies and quarterlies, the regular is normally where people go to establish their positions, and for that reason, they're normally going to be the most liquid. But if we're looking at something for an earnings play, we might look at a weekly option instead. So weekly options are going to expire every single week, and it gives us an opportunity to have a very short-term outlook on a certain underlying. So if I have an earnings announcement that is going to expire in a certain day, or Thursday or Friday, it doesn't really matter, I might be able to use a weekly that has less days to expiration rather than going to the regular, and that's going to give me a bigger vol differential or a bigger volatility differential, which might give me a better opportunity to take advantage of that high implied volatility spike, and thereafter when the earnings announcement is actually announced, it tends to decrease. So if I'm using a weekly, that might give me a better opportunity for an earnings play. Quarterlies are usually just noted as quarterlies. There's nothing really special about those. But for leap options, one thing to take out from this slide for leaps is that they're generally going to have a smaller theta decay because of the fact that there's so many days till expiration. So if I have a longer term outlook on something, maybe I'll look to buy a leap and sell options against it as we get closer to that expiration to reduce my cost basis. But leap options are generally going to have a lower theta decay when we're looking at all these together. So if we go to the next slide, we can talk about some other things about expiration, and this is going to be conversion. So it's really important for everyone to know what we're talking about with long calls, long puts, short calls, and short puts. So I love to review this. I think it can never be reviewed enough, but we're basically going to go through the conversions really quickly for expiration. So when we're talking about long calls and long puts, if I have a long call, it gives me the right to own shares of stock at a certain strike price for a certain amount of time, and that's the expiration we're talking about. So if I have a long call and it's in the money, and it has intrinsic value if it's in the money, that means that the option is worth something. So if I've got a long call, that means that my call strike is below the stock price that it's actually trading at, and for that reason I can buy shares at a discount compared to the market. So if I let that call expire in the money, it's going to convert into 100 shares of stock, 100 shares of long stock for every one contract that I have. Conversely, for long puts, it's just the opposite. So a put contract is the right to sell shares at a certain strike price. So a put contract would be in the money if it's above the stock price at expiration. And if I have an in the money put at expiration and I'm long that put, I'm going to see negative 100 shares against that put at expiration. So if I just own the put and I let it expire in the money, I'll see negative 100 shares in my account. However, if I own 100 shares and for whatever reason I might have bought a put to hedge against that, then the 100 shares would be taken out of my account and I would have no position in that underlying. That's essentially how it would work. If I've got a short put, however, I'm going to be long 100 shares. So if I've got a short put that's in the money, I might have sold it out of the money originally, and if the stock price did creep down below my put strike, which means that my put would be in the money then, if I'm short that put, that is giving the right for someone else to sell their shares to me. So if I have a short put, I'm going to have plus 100 shares or 100 long shares if I hold it through expiration and it's in the money. And if I have a short call and I let that expire in the money, it's going to be just the opposite. So I'll have negative 100 shares at expiration because, again, a call contract is the right to buy 100 shares. So if I originally sold that call, I sold the right for someone else to buy shares from me, essentially. And if I don't have those shares, I'm going to see that negative 100 shares in my account because we still have to give them those shares regardless. So if we go to the next slide, there's one more thing we'd like to talk about with expiration, and this is with cash conversions and cash indices. So this is one thing that took me by surprise when I first started trading. So I always thought that everything expired on Friday, the last day to trade things that were to expire on Friday, but that's not the case for certain indices. So if we look at the VIX, for example, it actually expires on Wednesday. So today is Tuesday. If you had a VIX position today and it was in the money, it would expire to whatever the VRO settle price was, and you would see that position gone by tomorrow, usually by midday. So that's one thing that differs in terms of equity positions and the VIX. So the VIX expires on Wednesday, so the last day to trade it is Tuesday. And for SPX, it actually expires on Friday. So for the normal expiration in SPX, for the monthly normal expiration, the last day to trade it is on Thursday. So one interesting thing about these indices is that it doesn't actually expire, or the P&L is not based on whatever the closing price is. It's based on the settlement price. So when the underlying actually settles, you can go into the platform and type in SET, or for the VIX, you can type in VRO, and you'll be able to see the settlement price. And usually it's a little bit different than the actual price that it closed at previously. So some people might say, I thought I had this P&L, but it actually ended up being this other P&L. And that's because the P&L is based on the settlement price. So again, for SPX, we look at SET. And for the VIX, we look at VRO. And this is important to know because we have other cash indexes that we might be trading. So it's important to see when they expire and what they're going to settle to. Because there's no actual stock for these things. You can't actually buy SPX stock or buy VIX stock. It's just a cash settled index. And therefore, they're called European options as well. So we can't exercise these early. So if we're short something, we're not going to be exercised early like we might with an American equity option. So let's go to the next slide here, and we will talk about another thing about expiration. So there's three things to be aware of in my mind for expiration, and they're listed here. So the first thing I'm going to take a look at is gamma risk. So I talked about gamma in a previous whiteboard. If you missed that one, you can just go to Find Shows at the top of Tasty Trade, scroll down to Mike and his whiteboard, and you'll see the gamma segment listed there. And gamma risk is essentially the rate of change of delta. And the reason I want to bring this up is that when we get closer to expiration, the gamma increases in our options. So the smaller movements in the underlyings are going to result in a greater change of delta, which can increase or decrease our P&L drastically. So it's something that we like to avoid. So we'll either close a position or roll it, usually at the beginning of expiration week or just before expiration week, to avoid this gamma risk. Another thing to be aware of is assignment risk. So the closer we get to expiration, the closer our options are going to trade like long or short stock. So if we have something that's in the money, it's going to be much more likely that we might get assigned if we're short an option, especially because there's not going to be much extrinsic value anymore in the option. And since options can only be exercised for intrinsic value, it makes more and more sense for the option owner to exercise it if they actually want to own those 100 shares of stock or be short 100 shares of stock, because of the fact that they're not really giving up anything. So when they exercise the option, they give up the extrinsic value. But as we get closer to expiration, there's not much extrinsic value left. So it's definitely important to be aware of assignment risk when we get close to expiration. And lastly, the last day to trade is super important. So like I said, with VIX and SPX, those are two things that I thought expired on Friday, but I believe I learned the hard way and saw that my position was gone the next day, thinking that I could still trade it throughout the week. So it's important to remember when the last day to trade something is. And again, for the VIX, the last day is Tuesday, and SPX, the last day is Thursday for the regular monthly expiration. So we've gone over a lot of things. Let's wrap it up with some takeaways for expirations. So the first takeaway is different expirations can have different liquidity levels. So again, we looked at quarterlies, we looked at leaps, we also talked about weeklies and regular option cycles. And generally speaking, the regular option cycles will tend to have the most liquidity just because that's the go-to for traditional investors. That's what everyone really knows in terms of options. But when we look at something like earnings, maybe liquidity would spike up during an earnings announcement for a weekly option because it's closest to that earnings announcement. So it's definitely something to keep an eye on, but just to be aware of the differences there is super crucial when deciding what expiration we want to be in and what strike prices we want to choose. Another takeaway is that the last day to trade is not always on Friday. So like we just talked about with VIX and SPX, those are different than Friday. So it's important to just understand and know where our expiration is. The CBOE actually has a great calendar that you can probably print out for 2016, and it lists out all the expirations and where things will expire and where the last day to trade things are. So definitely check that out. Our third takeaway is cash settled indexes expire to the settlement price. So like VIX and SPX, what we just looked at, they're not going to expire, or the P&L is not going to be reflective of the closing price. It's going to be reflective of that settlement price. So it's important to double check what that settlement was and make sure that the P&L reflects exactly what that should be. And last but not least, more expirations equal more flexibility. So if we only had regular option expirations, we would be confined to those specific expirations. Sure, they might be more liquid, but they wouldn't give us those opportunities for earnings announcements or other things that we would want to get our hands on in terms of weekly expirations or longer term options like leaps. So definitely more expirations offer us more flexibility, which is just another reason why we love trading options. So this has been an overview of expiration. Hopefully you've enjoyed it. Thanks so much for tuning in. If you've got any feedback at all, shoot me a tweet at Do, or you can reach out to us at support@do.com. We'll be back tomorrow at 3:15, so we'll see you there.